Most Americans are in debt, not because something suddenly went wrong, but because debt slowly became normal. Credit cards, auto loans, student loans, medical bills. For many people, debt starts before adult life fully begins, and it often stays longer than expected. On the surface, the explanations sound simple. People spend too much, prices rise, wages do not keep up. This story is repeated often. It feels complete. It feels personal. But it does not explain why debt keeps growing even when people try to be careful, or why escaping it feels so distant. In the United States, borrowing is not treated as an emergency option. It is built into everyday life. Homes are priced assuming a mortgage. Cars are marketed by monthly payment. Education is structured around long-term loans. Paying in full is no longer the normal path. Paying over time is. This system starts early. Many Americans receive their first credit card during college, sometimes before their first full-time job. The message is simple: build your credit. The card feels harmless, thin, light, easy to swipe. The cost does not arrive immediately. Interest stays invisible at first. What matters is not the purchase, it is the pattern that follows. Regular use, regular payments, balances that rarely reach zero. Every action is recorded, every payment date, every delay, every increase in spending. This data forms a profile, then a number. That number follows people everywhere. It affects renting approvals, insurance pricing, loan access. It is presented as neutral, just math, just risk. But profit does not come from people who pay everything off. Profit comes from people who carry balances. Interest is not a punishment, it is the product. Credit card interest rates often exceed 20%, sometimes much higher. These rates are not accidental, they are calculated. Low enough to feel manageable, high enough to grow fast. Minimum payments are designed carefully. They feel affordable, they keep accounts active. A person can pay every month for years and still owe most of what they originally borrowed. This is not hidden, it is written in the terms. But most people do not read dense agreements, and fewer calculate what long timelines really mean. The system does not depend on confusion, it depends on routine. Bills arrive, payments are made, balances remain. Debt becomes background noise. Auto loans follow the same structure. Cars are rarely marketed by full price. They are marketed by monthly cost. Longer loan terms reduce payments. They increase interest. Buyers focus on affordability today. The future cost fades into the background. Cars lose value quickly. Debt does not. Many people owe more than the vehicle is worth, sometimes for most of the loan period. Student loans work differently. They are taken before income exists. The promise is future opportunity. The cost is delayed pressure. Interest accumulates quietly. Balances grow while careers begin slowly. These loans are difficult to remove. They follow borrowers through decades. Healthcare adds another layer. Medical debt is rarely planned. An emergency happens. Bills arrive weeks later. Insurance does not cover everything. Statements are unclear. Deadlines are short. Payment plans are offered. Credit fills the gap. Debt enters without a clear decision. Housing costs tie everything together. Rent rises faster than wages. Buying requires credit history and savings. Those without credit pay higher deposits. Those with credit pay interest. Either way, money leaves the household. Behind all of this is data, constant, detailed. Every transaction is tracked, analyzed, scored. Financial institutions do not guess behavior, they measure it. They know when spending increases. They know when payments slow. Credit limits expand during stability, they tighten during stress. This protects lenders and stabilizes profit. Debt is sold as flexibility, as freedom, but flexibility has conditions. Missed payments trigger fees. Fees increase balances. Higher balances increase interest. A small disruption can escalate: a job loss, a medical issue, a family emergency. Debt does not pause. Interest continues. For many households, savings are thin. One missed paycheck creates pressure. Credit becomes the bridge. At first, it feels helpful. Later, it becomes heavy. Spending patterns shift quietly. Groceries go on cards. Utilities go on cards. Debt moves from major purchases to daily survival. This transition has no clear starting point. It happens gradually. People continue working, they pay bills, they appear stable. The strain stays private. Debt also reshapes time. Extra hours are worked. Second jobs appear. Income rises, but debt absorbs it. Interest claims the margin. Progress feels delayed. Advertising reinforces the cycle. Credit is framed as responsible, as smart. Rewards programs encourage use. Cash back, points. Small returns distract from long-term cost. Spending feels efficient, even strategic. Language matters. Balance transfer, low APR, deferred interest. These terms sound helpful. They extend timelines. They rarely reduce totals. Debt consolidation reshapes payment paths, often lengthening them. The system does not need people to fail. It needs them to remain engaged. Stable debt is profitable debt. Many Americans blame themselves. They feel behind, unprepared. But the structure does not reward exit. It rewards participation. Avoiding debt creates barriers, higher upfront costs, limited access. Cash-only paths are narrow. Over time, debt becomes expected, shared, normalized. Entire generations grow up inside it. Conversations shift from ownership to payments, from price to monthly amount. This framing hides accumulation. Debt is not just money owed, it is time committed, future income already spent. The system moves quietly, without force, without urgency. It relies on habits, on consistency. Most people do not collapse under debt, they adapt to it. Lives are rearranged around it. This is why debt persists, not because people fail, but because the system continues. It does not end with one loan or one card. It layers. Each obligation connects to another. Each payment feeds the next. The entrance is easy, the exit is unclear. Debt does not feel like a trap until years have passed. By then, it feels permanent, not loud, not dramatic, just constant. And for many Americans, that constant still carries a balance.